Greetings, fellow traders, and welcome to the presentation. The topic of discussion here is the CMRoadMap study. This is a price action based, 100% objective way of measuring price action to determine, number one, if either direction up or down is more probable than not, which way next and where. Okay, it's applicable to any market, any symbol, any time. Just so happens to be I have the most recent crude oil futures session, which was July 14, 2015, here in front of me. So let's work with this. Now this is the 24-hour set, the all session setting, 24-hour time period, and this is the pre-market, and somewhere around here is the 9 o'clock mark where the actual pit session started. I will say that when I'm trading a pre-market stretch, I don't take the 5-minute chart, the open range, or anything into consideration at all. How would we? That's prior to or after the fact of the pit session. The tool that we're talking about, this price measurement study, is only applicable during the pit session of any market or symbol, doesn't matter what it is, and it's designed to kind of see through the heavy HFT, the high frequency trading algos that shove price action back and forth, a lot of false moves, higher high or lower low traps and spikes and rapid reversals and things like that. So what I'm going to do is switch this over to the pit session setting of NYMEX, and away we go. Okay, here's a dramatically different view of the charts, and you can see in the past several days we're currently in the middle of the Greece economic crisis. Are they going to stay in the Eurozone? Are they going to default and leave? Blah, blah. And it's pretty much churned markets sideways heavily. Crude oil is off $7-8 a barrel from the recent highs, but for the past several days it's traded a range from 53 to 51, as you can see. And that wasn't any different today. So starting with today, when the pit session begins, whether you're applying this to the all session chart or the pit session chart is irrelevant, doesn't matter. What I do is begin with the first 5-minute complete bar, and then I attach a Fibonacci retracement grid using NinjaTrader charts. That is a F8 command. You just hit F8 and it gives you a Fibonacci grid, and so then I measure the first 5 minutes, which in this case is 9 o'clock a.m. Eastern Time to 9:05. Now, depending on which way the bar opens is how I draw the study. You can see that in today's case, it was a bullish or green bar, and the open, the low, high close resulted in a higher close than the open of the bar, and so I anchor the grid from the bottom to the top. It does make a difference in the measurement studies that we apply. Okay, in yesterday's case, July 13th on Monday, that was the opposite. The bar was bearish. It had a lower close than open, and so I start the grid on the high side and I anchor it to the low side. All right, we'll go back and look at yesterday in just a bit. So here we have the open range. Now a little bit of history. Back when I got started in 99-2000, everything was all about chart indicators, custom indicators, or tweaking existing ones such as moving averages, simple exponential, rounded weighted Hull, RSI, MACD, stochastics, Bollinger Bands, that type of thing. That is where retail traders mostly focused on trying to get just the right sweet spot of indicators that will show you more wins than losses. I was never able to find long-term success with that. I was fooled by randomness, and that I would have periods of time that were successful, but then afterwards not. And it wasn't until I actually focused on price action itself that I was able to identify statistical probabilities and long-term success. Before that, it was all randomness. All right. Unfortunately, many if not most individual traders fall back on trying to logic, guess, reason, gut instinct, which way price is going to go, and they do a lot of probing and fading. If price is testing support or resistance. They buy or sell or whatever the case may be. Nothing of structure. They have no idea what the probability outcomes are. All they're doing is just throwing stuff against the wall and seeing what sticks. All right. With this study in laying out the day, and I call this the intraday profile. This is the intraday market profile. It has nothing to do with volume profile studies. This is actually price action that is applicable to each given day, customized. Depending on the open and its range and its size, directly correlates to the price projections of where the market is going to go more often than not. So first, the measurements here that you've been looking at in the Fibonacci retracement bracket for whatever chart service you're using. Of course, the 0 and the 100, these are the outlines to that. And then I use the values of 233, 382, and 512, which are Fibonacci/Gann values. And I also use the same ones expressed in the negative, minus 512, minus 382, minus 233. When asked why I use these numbers instead of anything different, my reply is, I'm sure others work to some degree as well. I'm sure that you could plug in 250, 333, 500, or whatever other similar combination you might want, and you will find consistency there. I have no doubt, because that's how price is. It contracts and it unfolds in measured waves. But these are the numbers I began with. They work as effectively as anything I've ever seen, and so I'm staying with them. When it comes to statistical math and probabilities, and this is a long-term study, this has been researched and documented for years, at least the past decade, if not more, have had numerous traders who are part of the educational program here and others who aren't. Quantify this data by back testing through historical years on any market, any symbol. They'll set up an Excel spreadsheet, feed the data through to the market, and come up with these statistics consistently. The open range projection to the 233 zone, up or down, up, down, or both, are reached 90% of the time, month after year after year. All right, so going back in 10 years or more, any symbol, any market, when you have a pit session and you apply this open range measure and price is trading at or above the top of the open range, the 233 value up here has a 90% probability of being reached sometime during the day. Now that doesn't mean it's easy to catch, all right, because sometimes price will do this and it will pull back inside and it'll go on the low side and it'll chop around and then it'll explode. All right, just because you know where a market is probable to go doesn't automatically mean that you're printing cash hand over fist. It simply provides you the edge of which way you need to trade, and then you have to add your own elements of where do you get in and where do you place your stop to manage risk. And then, of course, where do you take those trades off for profit? That's a completely different process than what I'm showing here. I've never found a way, and I don't know anyone who has, that can mechanize a trading system, methodology, or approach based on the open range. I've never seen anyone who just uses this for their entry, exit decisions, and they're successful. If someone is doing that out there somewhere, I'm unaware of it. But it makes a hell of a trend filter, right? Telling you with statistical odds of probability where the market wants to go, because that gets hit 90% of the time. The next value, which I call the roadmap number 1, which is the 382, that gets hit on average of 62%, 62, 63%, 64%, consistently, month over year, any market, any symbol, it does. And the 500, which I call the roadmap number 2, that gets hit, wait for it, 50% of the time. 1 out of 2 sessions on average will go that far. Okay, the reason this is labeled number 1 and this is number 2 is I hadn't used the 233s early on. I didn't use them for the first year or two. All I did was project up these two values, and I would trade towards those in trend sessions, and quite frankly, I still do. All right. It wasn't until later that I noticed the I was actually introduced to this correlation by other traders who had taken the study and further than I did. All right. So to recap, the 233 zones above and below, either one or both in a given day, one or the other or both of them, 90% probable to be hit in any given day. Month over year, you can take those stats to the bank. The roadmap number 1 is roughly 62%, and the roadmap number 2 is roughly 50%. Well, those are incredible odds of statistical probability to put in your favor. And we did this today in the live room where we track crude oil. There was a buy, basically to run it through. Price traded below the open range. We're looking at a couple of sell signals that didn't perform, and we had long trade sequences marked and noted. They actually happen to be 51.95 and then 52.05, and then price went through and it confirmed the 51.95 buy signal and then the 05 buy signal, and then it came up and it almost hit the 233, and they went into this sideways chop mode, okay, where they pulled back, and then they exploded again. And they surged up and through the 233, and they went right to the roadmap number 1. And look where they magnetized. And then they created this wedge here, and then they traded right up to the roadmap number 2, about to the exact tick. I don't know if it is, but it's darn close. And then they backed off down to this roadmap, down to this one, and they settled here. This is not hindsight. This is not after the fact. This wasn't added to curve fit. This is a natural, objective, no BS approach that we knew and had documented at 9:05 Eastern, hours before. This didn't happen until noon. 3 hours prior to this, the grid was extended. The grid was measured. These values were extended, and this was an empty chart. And we're looking at price in here. We're looking at this bar, and these lines are already applied to the chart. And later on, afterwards, they fulfill the prophecy. And they do this day after day after day after week after month. This is nothing unusual, and it's certainly not limited to crude oil. This is what the markets do. It is the intraday profile. Yesterday, similar situation. Traded below the open range, back inside. Below the open range, double bottom situation. Fired right out to the 233. Pulled back to the open range, fired higher, turned over and came down. Right? Happens all the time. It's been going on, whether you've known it or not, for years, and it's going to continue to go on for years. I'm looking for a trend session. Here's a couple of trend moves. Those were range days. Here are trend days. Okay, so they traded up above a little bit. They didn't go anywhere, and then they traded down through. This is highly bullish. This is highly bearish. The bullish side didn't prevail. That would have resulted in losses. How would the bearish side do? All right, great. What about the next day? July 7th. This is a barely bullish bar. You can see that it's like a green hammer, if you will. And then price held inside the open range. They spilled out. They came down to here. They climbed back inside, back to the open range. And, that was the day. So trading away from the open range towards the roadmap values is the highest odds statistical probability that you can create for yourself. Here's the S&P. Been low volume trendy for a couple days. This was the 13th. This was the 14th. Now, in today's case, the opening 5-minute bar was about 6 ticks. It was minuscule. It was only 5 or 6 ticks wide. So what I do in that case, and it happens occasionally, not often, but once in a while, then I will just I'll defer to the 10-minute range, because nothing happened in the first 5 minutes. You can't even draw a grid. There's nothing there. And so they traded above the open range. You can see where they based on it nicely. They came up. This was news, 10 a.m. news, whatever econ report they spiked into. And then they went, of course, they hit and rejected the 233. There's your 90% probability. And then they went to this roadmap and then this one, and they pretty much stuck there into the close. Pretty cool, huh? I mean, this is the profile. This is what the market does. This is my discovery. I didn't invent this. I didn't create this. I discovered it by trial and error and application and a few other things. I figured out that the markets can be this predictable. It doesn't mean they're easily traded. Just because you know with a high odds probability that the market is going to go from here to there doesn't mean you can always catch that ride. Some days you take the entry of the methodology that you use to enter trades, whatever you're using now to enter a trade with, you still would. This is simply a generic filter. Okay, it's agnostic to any market or system, and you see that there is the probability of price action going higher, so you defer to your trade entry tactics, and you get long and you hold for the upside objectives, and everything's great. And then other times the market's going to be choppy. A few times the market's going to be explosive. You'll miss your fill by the exact tick or one tick. Wherever you decide to put an order in, whatever that might happen to be, by random statistical chance, you don't get filled. Believe it or not, traders have very little control over anything. We're predominantly type A personalities, and we hate lack of control. We want to control every aspect there is. But in reality, we don't. There's very little that we truly control as traders. All right? And so making peace with that fact, the few things that we do, where do we get in? Where do we place our stops? Which direction we're trading, and holding until profitable enough. Those are some of the things that we do control. And with that, using this approach, using this filter, matched up with whatever your trade entry tactic happens to be, takes you from trying to guess which way the market's going to go to giving you literally a roadmap with the statistical probabilities behind it of success. Okay? And it's really that simple. Let's take a look at, I'm going to go back a couple of days here, back a little bit. Take a look at one more example, walk you through the process. All right, here's a good one. This day right here, 709. So here's the open, and I measure it, and it's how wide. Okay, let's take a peek here. From 2062 to 2062.77, that the first 5 minutes was 3 ticks wide. We really can't do anything with that. And so we see what the 10-minute bar is, and the 10-minute bar is somewhat normal. And so now we have a range that's not much, from 61.5 to 62.75. That's pretty small, but that's what we have to work with. And so you can see the price action traded above, and it worked up into the roadmaps. Obviously it hit the 233s, came back down through the open range to the opposite side, fulfilling once again the 90% probability, traded to the open range. Look at all these contacts to the exact tick, down to the roadmap 2, back to the open range. This is a bearish evening star if you're into candle patterns, and then back down, and you can see where they stall on all of the roadmaps, see all the contact points of the roadmaps, and then they ended up tipping over and bleeding down into the close. Statistical odds of probability. You're no longer shooting in the dark. You're no longer trying to guess what the market may or may not do through instinct or gut feel or wild something guesswork. You have structure, you have objectiveness, you have statistical probabilities to work with, and if you stay aggressively long at or above the open range, and you stay aggressively short at or below the open range, you're going to catch the directional runs correctly more often than not. It's literally that simple. Hope this helps. Look forward to seeing you in the next installment, and as always, best trading wishes.